This is the exact formula I used to make over $30,000 in a single NASDAQ trade, and it works in any market when done right. Utilizing this method forms my all-time favorite entry model, and it actually makes up the backbone of my trading strategy. The two key ingredients of this formula are liquidity and trend. And in this video, I'll break down exactly how it works, then I'll show you the entry model and the entire trade system so you can start applying today and find high probability setups and consistent profits. Let's get into it. You see, when I started trading back in 2015, I had no idea what liquidity even meant. And it wasn't until I combined it with trend direction that my entries became consistently high probability. Now, the first thing you need to understand is trend structure. And I'm going to be using the pathway tool, which you can find over to the left on your toolbar, and just down here. You can actually favorite this or right click and use this to draw on the charts. Understanding higher time frame trend is quite simple. An uptrend is where you get higher highs and higher lows, and a downtrend is where you get lower lows and lower highs. And the idea here is to trade on the lower time frame in the same direction that the higher time frame is moving. So if your higher time frame, let's say the 4-hour time frame, is printing higher highs and higher lows, and you're taking entries off a lower time frame, you ideally want to be buying. And if the 4-hour is printing lower lows and lower highs on your lower time frame for entry, you need to be taking shorts. But the market isn't always as clear as an uptrend or a downtrend. From time to time, each market will do something called consolidation. And if you're not sure or experienced in what a consolidation is, it's basically when the market on a higher time frame is not printing higher highs and higher lows, and it's also not printing lower lows and lower highs. What it's doing instead is it's consolidating and bouncing from one side of the range to the other, often liquidating either side before jumping right back into that range. Now, there are different sizes of consolidations. Again, if we stick to this as a higher time frame, everything I'm explaining right now, use it as a 4-hour or a daily time frame. You can have much larger consolidations where you have 4-hour higher highs and higher lows, and then price moves into a low, takes liquidity, but then fails to break above the highest point and begins to consolidate. This can last weeks, if not months, before price actually commits to the overall prevailing trend. And if you're finding yourself in a range-bound market or a consolidating market, you're going to find it very difficult to become profitable. And the market can also give us smaller consolidations inside a trending market. So again, if on the 4-hour you're printing higher highs and higher lows, price comes down to take a low, but instead fails to close above a high again, just takes further liquidity before continuing, you've still found yourself in a consolidation, just short-lived before it continues that trend. And now there's one thing that can help identify when a consolidation is likely going to start. And that's how price reacts to a previous high or low. So let's take an example again of a bullish market. So previously the 4-hour time frame is printing higher highs and higher lows. And each time it breaks a previous high, it breaks with commitment. It breaks with multiple candles, with body closes and not wicks. But then on another run, it wicks and comes right back inside, doesn't close above, or if it does, the next candle closes right back inside again. And we see either a equal highs or a wick above a previous structural high. That's your indication that price is likely going to become range bound and to likely avoid that market and go and seek clarity in a different asset class. I will show you a price action real example later on, but there is another incidence where you're likely to see a higher time frame, again in a 4-hour time frame consolidation, and that's when we have a large impulsive move like so. And you can expect price to be very range bound inside of this move, quite often seeking liquidity at the resting below the origin of that move before then continuing in that higher time frame. These moves usually occur after fundamental news releases such as non-farm payrolls, core retail sales, unemployment claims, and FOMC. And by the way, these consolidations happen on all time frames. So now let's look at NASDAQ for some live examples of 4-hour trend, 4-hour structure, and identifying whether we are trending or consolidating, and knowing the early signs that an onset of consolidation is likely going to occur. So we see here price is breaking above previous highs, and it's breaking with commitment. We are multiple candles closing above. These are full body bullish candles, and price is continuing higher. Even when price comes back to take liquidity below these lows, it breaks above this structural high again with commitment. Body closes, bullish candles, it keeps pushing. We see the same thing occur again, a break of structure. It's only one candle but with a full body, and once price takes liquidity a number of times, it goes on to break structure again with more commitment, showing intent in the market. But what happens later on when price slows down? It runs out of steam. We can see here, barely close above, we see wicks, we see more wicks, we see more wicks, and another wick. We are expecting then consolidation in the markets, even though this is only short-lived before it does continue higher. But still, instead of taking liquidity and continuing, it consolidates. Instead of taking liquidity and continuing, it consolidates. And remember that second scenario where I said if you get these impulsive moves, price is likely going to consolidate until the origin is taken out. If you look at this impulsive move here, and instead of price continuing like so, as you would expect in a bullish market, what happens instead is it comes right back down, takes the lows, consolidates in this region before then continuing eventually higher. So now let's take two live examples on the 4-hour time frame on NASDAQ, looking at a consolidating market versus a trending market. Because what we want to be doing first of all is understanding when is the right time to trade and when is the wrong time to trade, and actually to sit on our hands or look at a separate market altogether. So here we have a period of consolidation in the NASDAQ which lasted around 20 days, and we can use a Gann box tool just over here on the left, drop down, use a Gann box just to plot a high and a low and drag it all the way across, just so you can see the lack of commitment to both sides of the market. First of all, we know we came from a bullish market. However, when price is breaking the highs, it's failing to continue. It's either closing above and then closing inside the range. It's wicking and back in the range. It's wicking to the upside and back into the range. Even when it comes to the downside, it wicks and closes above and it comes back into the range and wicks one more time before dropping to the lows again. Each time it's failing to close below and failing to close above until eventually 20 days later, it commits to the upside. Versus that following period, which is around 34 days, where the market is continuously breaking highs and committing to the upside, giving us a really clear higher time frame trending market. Now you can trade these periods, but you have to realize you need to be more patient, you need to be more selective, and you're likely going to take more losses in a consolidation on a higher time frame versus a trending clear market on a higher time frame. The second element is identifying liquidity in the market. So we'll use our pathway tool once more and identify a trending higher time frame market, which is higher highs and higher lows. But we know that the market doesn't simply just work in higher highs and higher lows. The market likes to take liquidity. So in a bullish market, we have sell side liquidity where the market drives beneath a previous structural low before continuing to the upside. And it's at these levels where we want to really identify our entry model on a lower time frame, because this is where stop losses has been ran and there has been fuel added to the overall direction of the trend, and price action is going to be very impulsive once liquidity has been taken. Similarly, in a bearish market, which is producing lower lows and lower highs, we are eventually going to take liquidity before continuing in that overall trend direction. And understanding that liquidity run and having a lower time frame entry model inside of this area, we are targeting the structural lows in this case, is our high probability, higher time frame area that we want to be looking at opportunity. Now, when it comes to a consolidation, again, we can trade these markets, but just knowing that it's going to be much more difficult to predict, you're going to have a much lower win rate, and it's going to give you a headache. But you can also identify these areas of liquidity when price takes both sides of the market, and you can trade often from one opposing side of liquidity into another and keep trading along with the overall higher time frame trend. But note that the trend is your friend, so sticking to a higher time frame trending market is always going to be favorable. Let's cover some real chart examples. So we come back to NQ on the 4-hour chart, and I'm coming back to this period over here for a reason, because we went from a bearish market into a bullish market when we continued breaking higher highs and printing higher lows along with it. Now we can see that we start to create a trending market here, and breaks of structure are when price follows through in that overall trending direction, again with commitment, whereas sweeps of liquidity are the opposing side, which takes orders and it takes stop losses, adds fuels to the market, and then allows price to continue in that overall intended direction. So it's these areas that we want to be really efficient in understanding, that they are going to be the higher probability trade areas. And we can see again, price moves into these lows, takes liquidity before then continuing again to the upside. Lots of momentum in the market when we have these trending conditions. We can see it once more. Even though this area starts to consolidate, we can still continue trading on the lower time frame with 4-hour or higher time frame liquidity until price starts to break down, and then wait for those consolidations to complete, such as this break of structure. And then we know after this impulsive run, it's very inducing. We want price to come down to the origin. We explained this earlier. Price takes this level and runs liquidity anywhere in here. As long as we have our lower time frame model, we want to be taking entries and targeting the higher time frame structure once more. We then of course come over this consolidating period, which we can choose to leave alone if we wish, and just wait for commitment. You can see here where price is taking highs and driving to the lows, takes liquidity, drives back into highs, takes liquidity, drives back into the lows, takes internal liquidity and drives back into the lows before taking this last pool of sell side liquidity and exploding to the upside. It's much more difficult, it's lower quality. You can leave that alone and wait for commitment. And then what do we get? We get a 34, 35 day trending market where let's identify sweeps of liquidity like so. These areas are high probability for buys. Price then breaks structure with commitment. What does it do? It comes back for more liquidity below these lows. So we will mark this run on liquidity right here. Sweeps this high. So we have a miniature consolidation here. So we'll use our gam box on this low and high just to show the lack of commitment. But we can see it sweeps the highs, runs right into the lows, sweeps the lows. We'll borrow this. This is the area to take buys because we are assuming we are going to be breaking highs and continue in this bullish market until price commits, shows its hand and continues on this higher time frame journey. So we have one more break of structure here before price comes into another 4-hour low yet again, sweeps liquidity to the downside yet again before going on to break the higher time frame structural high. Let's go for one more because we can see one just over here. We are still in a trending market. Price fills this gap, takes liquidity not just once, but takes it again a second time. We know that some of these may be fundamentally driven, but the concept remains the same. And then finally, we break this structural high here. And then we see this sell off here, which again is another run on higher time frame liquidity in itself, just on a higher time frame. But what about the entry model, you're probably asking? Well, we've covered the higher time frame, which is super important. You don't necessarily need a higher time frame bias, but it really helps. Next up, I'm going to be showing you my entry model on the 15-minute time frame and looking at both structure and liquidity on that time frame before executing my A+ entry model. Now, there's two things that my entry model consists of. The first thing is what we've just covered, that higher time frame structure. Are we in a trending market? Are we near a liquidity pool, or have we recently taken higher time frame liquidity, and do we have a structural target to aim for? Next up on the entry model, which most of the time is on the 15-minute, you don't need any lower time frames than that, especially if you're working a full-time job or running a business. You don't need to go any lower than the 15-minute. And I need session-based liquidity on that time frame mixed with timing. So I'm going to be using a kill zone indicator, and I'm going to set this up on the chart with you in a moment when we go over some live examples. But first of all, let's draw on the actual entry model. So first of all, we have our kill zones, which are Asia session, London session, and New York session. These are the time frames that we want to be aware of where certain levels of liquidity and volume are entering the market. Now, this depends on what asset you're trading. It's different for Forex, for crypto, for indices, for commodities. However, we stick to NQ, NASDAQ, so the US tech stock index. And this is what I trade on futures, and this is what I recommend you follow with this system as well. We know that if you go back in time and use volume candles, you can see that the trading volume on NASDAQ is always in the New York trading session because that's where most of the volume lies. And what usually happens here throughout the day is we get consolidation during the Asia session. We will either get the early onset of continuation during London, or this will be early manipulation during New York before New York comes back, takes the major liquidity of the day, and then makes the major move of the day also. Now this very much depends on how London behaves after Asia and how New York then behaves after London. If London does not take liquidity resting below Asia session, then New York session is very likely to come back and take out either London lows or all of the liquidity of that trading day. Whereas if London takes liquidity, New York is likely to continue, either just by taking London liquidity or it will continue without. Let's look at some live examples and I'll show you how. So the first thing we need is a session-based indicator. So what you need to do is type in FX sessions, and you want to look for the FX market sessions by Boytoki. You can click on this, add it to the charts, and it will come up like this. The next thing you need to do is to go through the metrics and change for your time zone. For me, it's GMT +1, and then give your indicators the right time settings. So I'm in the UK, so my London session is from 8 AM till 10 AM. My New York session is from 2:30 British Standard Time, which is 9:30 Eastern Standard Time, and that closes at 4:30 PM. And the Asia session is from midnight until 6 AM. And then of course you can color code these how you wish. If you scroll down, you can change your theme. You can have box, you can have hamburger, sandwich, or just background. I like to just keep a background for these. And then when we zoom in, you can see that it's very clean. We've got the labels that you can actually have on show or be removed. So you can clearly identify what your sessions are. You can also remove this box in the top right-hand corner. Any information and Fibonacci levels are not necessary for this strategy. Next up, what you want to do is head over to the top left where you've saved that sessions indicator on your chart. Click on the three dots where it says more, copy, then right click and paste the same sessions indicator in. And we're going to edit this to actually input the crossover times between the sessions. So let's start with the Asia session, which is midnight till 6. That's fine, that doesn't need to be changed. But then we want to run our London session from 6 AM, and that will run through till 12 PM midday. And then lastly, New York is going to cross over from that 12 PM and close at 6 PM UK time. Now, in order to separate the two from each other, I'm going to turn this into a sandwich, make this a solid line, and then when I go up to each session, I want to extend these lines. Now what you can see on the chart here for the current trading day is it's plotting the beginning of Asia or Tokyo session right through till the London cross, and we haven't played this yet. I'm using bar replay to show you a trade example that I caught live on the Friday, the 8th of August. And it will carry through. It's still showing the New York session of the previous day, but this indicator will carry through. When the New York session of today opens, it will transfer over from the previous trading day. And what this is doing, it's allowing us to identify the true highest point of each trading session. So we have the Tokyo low, which has been taken. So we can identify that level as taken. We have the Tokyo highs here, which has not yet been taken. So I'm going to extend this across as available. We also, at this point, we don't have London play out, right? But we're not trading London. This is about liquidity, trend, and timing. So I'm going to play this forwards because this is a New York trading strategy. And we'll play it forward until just there. So now we can see that London has taken Asia lows, and because our higher time frame trend is to the upside, we expect these highs to be taken as a break of structural point. Now, do we have other levels of liquidity available? Yes, we do. We have the absolute lows of London, which is the lows of the day, but that's unlikely to be taken because of what I said earlier, because London has taken Asia, but I'm still going to mark it on there anyway. I'm also going to mark on the actual lows of the London trading session rather than the whole crossover, and mark that on here as well. And I'm going to drag these all over because this is the only external range high and low liquidity available at the moment. New York session can come in and create its own areas of liquidity, like so, before running into those lows and continuing as well, but we haven't got that example yet. Now let's play this forwards. We expect price to reach these highs because our higher time frame bias is bullish. We also don't expect New York price action to come all the way down into the lows of the day, although it can do that. And the reason I don't expect that to happen and didn't on that Friday is because this run on liquidity ran into the Asia lows. If that had not have happened and London was up here, I'd expect exactly this model to come and take the highs. But instead, I'm expecting some sort of run on liquidity, likely after breaking structure, just inside or below the London low session, and then a continuation to the upside. I'm just going to remove the background color on this to clear that up. There we go. Okay, so as a recap, the liquidity resting above the highs of the day and above Tokyo highs, which have not been liquidated yet, I'm expecting them to be taken as a target and a break of structure to the upside because the higher time frame narrative, the structure, the trend, the liquidity is to the upside. I am expecting at least these London lows, the London trading session lows, 8 a.m. to 10 a.m. UK time, to be ran before price continues to the upside. I'm not expecting the overall lows of the day to be taken, which is the lowest point of the London crossover, because London has taken Asia lows and we are bullish. However, it's still possible. This is the 12 p.m. crossover between New York and London. So I'm not trading at this point. I'll typically trade around 2:30 British Standard Time, which is 9:30 Eastern Standard Time. But if I do get an alert, which I right click on this area and set an alert, or set an alert on this line, if that triggers from 1:30 onwards, I will look for a trade. Now let's wait to see what happens when New York opens up. We see this run in to the downside, which takes out the London session lows. Liquidity has now been taken. We know that it can still come down here, yet we don't have a bullish retrace candle on the 15-minute, which is the last point before I look for an entry. Here we go. Now we can either take this on a 1-minute, which I actually did, but you can take this off the 15-minute as well. Now we have a 15-minute close. Now stops, just give a breathing space below this low, and we can target at these highs here. I got in with a lower time frame, so I got around a 3-to-1 on this one. But for the purpose of this video, again, most of you want to trade less, want less screen time. You're probably working a busy job or have a very busy business and you want to trade on the side for around 1 hour or so in the afternoon. This is ideal. This is all you need. Taking liquidity. We've identified the bullish market structure on the higher time frame. You've got that 15-minute retrace candle. You can either market execute on the close or put a buy stop order at the highs, and there's nothing stopping you from actually trading higher, but just know that more of a day trading scalping strategy, you can target these highs. And just for the purpose of this video, I'm just going to target these highs here for around 1.8, 1.9 to 1. So let's play this forwards, and you can see that price tags us in. This is a very impulsive day. There's not always that much volume in the day, but this entry model repeats itself time and time again. If you want to see exactly how I manage risk after finding the perfect entry, watch this video here where I explain it all. And if you'd like to take your trading to new levels and you'd like to work one-on-one with me, if there is a link in the description below the video, that means there are spaces available in my accelerator program. Due to the one-to-one personal nature, I do limit spots. So if there is no link in the description, it means I'm full, but there may be a waiting list below, so go check it out. And before you leave, make sure to subscribe to the channel. I do upload videos like these every single week for free, and I'll see you on the next one.